All right. Hello, YouTube. So, we just got a brand new tax bill dropped on us. It is a proposed bill. It's not law yet. However, it's giving us a pretty good roadmap of where the administration wants to take us for the next 4 years. The name of the bill is the One Big Beautiful Bill. So, there's a lot of stuff in it. I think it's about 327 pages. I cherry picked the five either most interesting or most impactful things if you are watching this video. So if you are someone that is self-employed, you run a business, or honestly, there's things in here that are going to impact every single person. So there's a little bit in here for everyone. So let's jump right in. All right. So the very first thing, so the modified $30,000 cap on state and local tax deductions. This is big. This is a huge change, especially if you are someone in a coastal state that has very high home prices, very high state income tax as well, like California or New York. So really quick, for the people that don't know, the IRS basically hands you two buckets. One of them is going to be pre-filled with a $30,000 standard deduction. The other bucket is empty, and they tell you, hey, if you can come up with your own expenses, and the sum of all of those expenses is going to exceed $30,000, whatever this number may be, then you can go ahead and use your own bucket. Cool. So in the past, people, they put in their medical expenses, their property tax, state income tax, mortgage, all that good stuff. And oftentimes that would exceed what the standard deduction was. But recently, like in the past 7 years, there was a cap on how much you could claim between property taxes, vehicle registration, and state income tax. And that cap was $10,000. So for a lot of people, again, in those coastal states, their property taxes alone might exceed $10,000. So they weren't really getting a benefit for their state income tax paid. This proposed change is going to triple how much you can actually take from this category. So what's going to end up happening is that a lot of people are going to be able to itemize their deductions. This could translate, depending on your tax situation, easily into another $5,000-$10,000 of money in your pocket starting in 2025. So big changes coming pretty soon if this bill passes as it is. All right, so the second thing, they are extending 100% bonus depreciation. So at the moment, bonus is set to 40% in 2025. So if you go out, you're a business owner, and you do the rational thing, which is to go buy a $100,000 Land Rover, you are only going to be able to take 40% of the cost of the vehicle in the year that you purchased it, which is 2025. The proposed change to the bill, to the tax law, is that we are going to be extending the 100% bonus depreciation. So the same Land Rover, you go out, you buy it, well, now you can deduct the entire cost of the vehicle in the year that you bought it, which is huge for a lot of business owners. Now, I simplified this a lot. Obviously, there's a lot of other equipment, a lot of other stuff that is legit business that we're going to be able to deduct. So that's a big one as well. Okay, so new tax planning, which is great for me because I'm always trying to find ways to save my clients money. The Money Account for Growth and Advancement, otherwise known as the MAGA account. This is going to be really fun to explain to my clients why they're seeing MAGA on their tax planning documents. So basically, they're making a new tax advantage saving accounts for children who are under the age of 8, which I think is awesome. I always welcome more ways to put money away and get a tax benefit up front for it. If I could pull some heartstrings and tell my clients that it's for their kids, they're much more likely to actually save some money and save some money on taxes. So I'm all for this. I think this is awesome. It's just going to be a fun time trying to explain to my clients why they're seeing the MAGA on here. All right, so number 4, increasing the 1099 thresholds. If you are in business, you know what a pain in the butt it is to file 1099s at the end of the year. And I welcome this change. I think it's been a long time since they've updated the threshold here. I don't think it's kept up with inflation. And they're going to update that to be $2,000 paid to a contractor throughout the year, instead of $600 being the minimum. If you meet this qualification, then you have to issue that contractor, business, whatever, 1099 at the end of the year. So this is going to help with the compliance portion here. The other one they're mentioning is the 1099K. So if you are using kind of a payment processing merchant service, they're going to issue you a 1099 basically showing you how much money you made. So this one they've gone back and forth on quite a bit. $20,000, 200 transactions. I think that's still pretty fair. But the one that's really going to impact most people is going to be the 1099 NEC. All right, and then finally, number 5. So there are 3 proposed changes here, which I think are pretty important, or pretty different, I would say. So going back to my concept before of the buckets, right? You get the standard deduction bucket, or you can try to come up with your own expenses and try to fill this bucket up. That's great, but you're having to jump through hurdles and you may not actually get any benefit for certain expenses. The above the line deductions bypass that mechanism, and regardless of whether you take the standard deduction or you are itemizing, you're still going to get to take advantage of these deductions, which is great because that means every person basically qualifies for this. So they are proposing a deduction for qualified tips. So if you're someone that works a job and you make tips, they are proposing some sort of tax break for you on those tips, which is awesome if you are someone that reports their tip income. The second one is qualified overtime compensation. So they are proposing some sort of tax break for you if you make overtime pay. I think this is very interesting because it's also going to open up a lot of tax planning for those clients who own their business. They put themselves on payroll, and obviously they have control of the structure of their pay. So there's definitely more tax planning opportunities to come from there. I don't know what the qualified means. Again, this is the draft bill. It hasn't actually made it into law just yet. So eager to see what the heck they mean by what is qualified, what counts versus what doesn't count. And then finally, interest on passenger vehicle loans. So for me, at least in my professional career, this is the first time I'm seeing non-business related vehicle loans. We're going to be able to deduct potentially that interest that you're paying on your car payments. So this is pretty big right now with the way interest rates are. A lot of people getting car loans right now, best case scenario, they're getting 6-7%. Worst case, some people are paying 15 to 20% on their vehicle loans. So they are proposing that you could get some sort of tax break on that interest that you're paying for your car note, which is, awesome if that does actually come through. So that is kind of the summary here. I just picked out the 5 most important or most interesting things that I found on here. The bill hasn't actually made it all the way through where it needs to go to be a law, but this is giving us a pretty good sense of, again, where the administration wants to take us, what their priorities are in trying to get certain tax deductions passed or adjusted. So it looks like they are going for, some tax breaks to the people, both business owners, people that are making a lot of money, and also just, regular Americans that are, making tips, they're getting paid overtime, or they're paying a bunch of money on their car notes. So excited to see where it goes.